So, let's start. I know that presentations following lunch are tough, so I will try to keep you busy and awake. I prepared some quizzes, so let's start. My name is Thanos Batsilas, and I'm going to present other direct costs. So, in this presentation, we are going to hear about 5 cost categories: travel costs, equipment costs, other goods and services, large research infrastructure, and internally invoiced goods and services. Actually, we have 5 cost categories, 2 different forms of costs. 4 categories are claimed under actual costs, and 1 under unit costs. And for one cost category, you need a grant agreement option. So, travel-related costs are not only the fare, it's not only the train ticket or the airplane ticket, but also the hotel and the subsistence. These costs can be incurred during the project period, of course. Who can travel is the personnel of the beneficiary, or even one external that is invited to give a speech. How? There is no particular calculation, and all you need is to claim the actual costs of traveling. If there is any restriction regarding the location, there is no restriction, even if it's out of Europe. So, the quizzes. Project starts 1st of January 2018. The kickoff meeting is planned for 15 January 2018, but the airfare was bought on 15 December 2017. That means before the start date of the project. Is this airfare cost eligible? The correct answer is C, as most of you chose. It's true that it's the action task is the meeting itself, not the purchase of the ticket. Next quiz. No traveling documentation kept. Is this cost eligible? We'll give you 30 seconds. Yes, it's B. This is basic and main eligibility criterion, actually. And I dare say that the majority of rejected traveling costs is due to this. You throw away the boarding pass. Next quiz. Beneficiary claimed the cost of a business class airplane ticket. Is it eligible? Let's see the correct answer. Wow, 100%. Yes, as simple as that. If this is the policy of your organization and it can be demonstrated, then all is fine. A tricky question now. Beneficiary reimburses travel costs as a lump sum per diem payment. This might differ from the actual costs. What is eligible? Okay. Yes, it's B. It is maybe the only and one case where the costs accepted are not actual. Next quiz. Are entertainment and hospitality expenses like gifts, special meals eligible? Correct answer is A. Correct. No Chateau Petrus, no caviar, no exaggerations. This is public money for research and innovation actions. So, next question. Beneficiary flies from Paris to Helsinki for a project meeting. After the meeting, instead of flying back to Paris, he flies directly to New York to participate in an event not related to the action or on personal trip. What can be charged? I will give you 45 seconds to reflect on this. This is a $1 million question. Okay. Yes. Correct answer is C, not B. This has happened to many of us, I think, and we are here ready to help you to reconcile your project obligations with other business activities or your personal life, but not a detriment to EU taxpayers' money. That means that we are ready to pay only the part of the flight that you could have spent going back home from Helsinki to Paris. If you can demonstrate that, we can even pay this part of your travel to New York. Next. Is there any ceiling amount to traveling costs? Let's see the answer. Wow, that's true. There is no ceiling. What means sound financial management? It means economy, efficiency, and effectiveness. And of course, no excessive or reckless expenditure. So if you need 5 minutes to discuss, you don't travel, you can arrange teleco. If you feel that prices are high, pick up the phone, call project officer, call us, consult us, and we will let you know if this is worthy or not. And with this, I finished the travel costs, and I will pass on another very important and big cost category, the equipment costs. So, when we say equipment, we also mean equipment, infrastructure, and other assets. And this can be purchased or already possessed, read or leased, or made available by third parties, in other words, contributed in kind against payments. So depending in what category, to what category they belong, you claim the costs accordingly. So if it's purchased or already possessed, you claim the depreciated costs. If rented or leased, you claim the costs of this leasing. And if it's given by a third party, contributed in kind against payment, then you claim these costs. Some principles. Eligibility criteria must be met. Best value for money, and I will elaborate on this in the next slide. And written off in accordance with the accounting principle of beneficiary and international accounting standards. Now, for the best value for money and the conflict of interest, how we ensure this principle? The most easy is just tender. We procure, we have a competitive selection procedure. And if no request or several offers, then you must demonstrate how this principle is met. Also, price is very important, but not automatically an essential aspect. It's an essential aspect, but will not award you don't need to go directly to the lowest price. Nevertheless, this can be very, very useful when the process is automated or you have a lot of tenders. Then a pre-existing framework contract, if awarded on best value for money and the conflict of interest. And of course, if you are a contracted authority, then you follow the national law on public procurement. Purchases between beneficiaries. In principle, this is not allowed. If X needs supplies from another beneficiary, let's say Z, it is Z that should charge the costs to the action. And the purchases between beneficiaries will only be accepted in exceptional and properly justified cases. The calculation, I go back again to depreciation of costs of equipment. This is the way how we calculate. So depreciated costs equal to the months used in the project divided by the depreciation period according to the accounting policy, multiplied by the purchased price, excluding VAT if not recoverable, and multiplied by the percentage of usage in the project. So, this is a specific case. We spoke about purchase equipment. Let's see now what about build a prototype or a pilot plant. In this case, the full construction costs may exceptionally be eligible as equipment costs if the following 1, 2, 3 criteria are met. These are building the prototype or pilot plant is explicitly an action task indicated in Annex 1 of the grant agreement. The costs are foreseen in the estimated budget, and the general eligibility conditions are met. In particular, recorded in the beneficiary's accounts in accordance with the national accounting standards and with the beneficiary's usual accounting practices. So, costs of rental. If the general eligibility criteria that Antonio mentioned at the start of this workshop are met, then it's okay. The total leasing, renting costs should not exceed the depreciation if this equipment had been bought. And of course not include any type of costs like financing fees. The calculation depending if it's an operational leasing, then that means that the asset it's not recorded in your accounts, so no depreciation is subject here. So the costs will be just the leasing fees. If the equipment asset or infrastructure is booked in your accounts, and here we are talking about the finance leasing, then the depreciated costs, excluding interests on loans and finance charges, cannot exceed the costs that would have been incurred if the equipment had been purchased and depreciated under normal accounting practices. Yes. So this is the case where a third party, a contributor in kind, make available an equipment or infrastructure, laboratory. So in this case, again, general eligibility criteria are met. This cost should not exceed the depreciation costs of similar equipment of your organization, not include any financing fees, and fulfill the conditions on in-kind contributors, of which the basic, the most important, is that you claim costs and not prices. The calculation, the costs must correspond to the amount paid by the beneficiary and must not exceed the depreciation cost of the third party. So in case of audit, I'm afraid that here the auditor may also need to audit the depreciation policy of the third party. Other direct costs, quizzes. So, quiz number 1. Can depreciation costs for equipment used for the project but bought before the start of the project be eligible? correct answer is A. It's true. If it hasn't been yet fully depreciated, you can still claim costs. Next quiz. Beneficiary respected all the rules related to depreciation. However, 100% of the costs were rejected. Why? I think it's quite easy, this. Okay. Adonio, it's you, right? Okay. Anyway, if it's not you, he will pay the beers after the workshop. Okay. So no logo, no money. We have become very strict, and there are clear instructions, not tolerance. I think that this is the minimum that one can do when receiving help, is to acknowledge from where he receives this help. Last but not least, everybody wants to see where the money goes. We are all EU taxpayers. We contribute to this, and personally, I like to see to what I contribute. Next slide. Equipment is used in FCH joint undertaking project, but also in several other activities. The usage in FCH joint undertaking hasn't been measured, but estimated. Are the depreciated costs eligible? The correct answer is yes. A. Sorry, but if the equipment is used in other projects, you should set up an auditable and verifiable system. How you do that? It's from time recording to measure meters, so it should be auditable and verifiable this time. Next slide. Quite big for my style, I would say. According to beneficiaries' accounting policy, any equipment of value under 5,000 euros is not subject to depreciation, and it is not recorded as an asset but as an expenditure. This is also below the low value ceiling as defined under national law. The equipment used 50% in the project. How much is the depreciated costs? I will give you 20 more seconds, as the quiz is quite long to read. And the correct answer is not A, but B. It's B. There is no depreciation here. This is the accounting policy aligned to national law. So for an item under 5,000 euros, even if it's equipment in nature, they don't consider it as an asset. So in this case, we only take into account the use in the project. In this case, it's 50%, so the half price is eligible. And now, let's pass on another important and big cost category, other goods and services. These are consumables, supplies, dissemination, certificate financial statements, translation, catering, publication, IPR, intellectual property rights. So when, again, it's a very important eligibility criterion during the project period. Who claims these costs? Either the beneficiary that purchased these consumables, but also the beneficiary can receive this from an in-kind contributor against payment, so can claim the costs of this contribution. There is no specific calculation method. The cost must correspond to the eligible cost actually incurred. Let's go to the quizzes related to this cost category. Beneficiary bought consumables amounting 3,000 euros, VAT included. Is VAT eligible costs? "30 seconds for this, for your replies. I see that you all waiting for the reply, so the correct reply is B. So if you are able to recover the VAT from your VAT tax authority, then VAT isn't a cost, right? Then why it should be eligible? So if you can recover the VAT, it's not a cost anymore. You get it back. So, but if you cannot recover it, then it's cost, and it's cost for us as well. Beneficiary's budget for open research data is 10,000 euros. However, the actually purchased price was 12,000 euros. The correct answer is C. Yes, I would like to underline for once more, let's not confuse indicative budget and actual costs. Always claim actual costs. Next quiz. Beneficiary will operate an electrolyzer. Can the electricity costs be claimed as other direct costs? correct answer is, you say B, someone said, you said C, someone B, but the correct answer is A. So if you can measure, and in addition to the ability of measuring the electricity costs, the accounting system must also recognize these costs as direct and not as indirect costs. Next quiz. Beneficiary bought a necessary consumable not initially indicating the description of action. Can it be still claimed? If I'm not mistaken, maybe we also already touched this issue. The correct answer is, correctly, most of you replied C. So it is absolutely normal that we cannot foresee all the costs from the start. If this is the case, that you have a necessary cost that hasn't been foreseen, contact the PO, the project officer, discuss the issue, and see, he will tell you whether you need an amendment or not. Or, as I think Georgiana previously mentioned, if it's mentioned in the report as a cost not foreseen and you justify properly, then most of the times we don't need an amendment. Can the certificate financial statement cost be claimed even if incurred after the end of the project? So the project ends today, but the CFS is issued, paid, bought, prepared after this date. Fifteen more seconds. The correct answer is A, correctly. So unless an early terminated beneficiary or beneficiary's tasks executed before a date, and therefore no other costs, the CFS normally would incur after the end of the project. Okay, so exceptionally, costs related to the financial reporting, the preparation of the financial reporting, are eligible even if incurred after the end of the project. And one of these costs are the CFS. Next quiz. Services are supplied during the action duration, but the costs are invoiced or paid after the end date. What is correct? Thirty seconds. The correct answer is A. Next quiz. The accounting system considers maintenance, communication costs, and postage as indirect costs. Can I charge these costs other direct costs? For example, I post a letter and I know it cost me €2.50. I know the exact actual amount. Can I claim it as other direct cost? Five, 10 seconds more. The correct answer is C. It's true. If indirect cost for you, why it should be direct cost for the FCH joint undertaking? Next slide. Supplies and consumables had bought and been already in the stock of beneficiary before the starting date. Are they eligible? So the correct answer is B. Correctly. And I think it makes sense, doesn't it? And also makes sense that if you buy something and you don't use it, it will not be eligible as well. Next slide. This is for lawyers, I think. Royalties paid for IPR access rights are normally eligible if all eligibility conditions are met. What from the following is not correct? We'll give you 45 seconds to reply. So, B and C are correct answers. As a statement, I mean. And the not correct reply is A. And I'm happy that lots of you found it. Next, self-produced consumables with an accounting value in the inventory of beneficiary. Can these consumables be claimed and how much? correct answer is C, correctly. For example, if your company manufactures wires and you need wires for the project, will not let you go and buy from someone else. But for sure, we will also not let you charge the price that you sell these wires. Only the costs to produce these wires. I think this is the last quiz from this series of quizzes, other goods and services. A temporary work agency provided staff to beneficiary to assist in administrative tasks related to the project. What is correct? I think this question is a bit of combination of what Nora presented, myself, a bit Georgiana, yes. So once this is the last question, I will help you. Focus on what are the tasks. Are core tasks, are minor tasks, are tasks indicated in the description of action? What type of tasks? So the correct answer is C. Correct. Yes, let's move to another cost category. Actually, I will go very fast with this slide, as only 7 or 8 beneficiaries in the entire Horizon 2020 program are eligible to claim these costs. Just in case, however, that you are interested in knowing what is LRI, or your organization is a quite big organization and you would like also to apply for this certification, I would say, not certification, to be eligible to claim LRI. So we are talking here about capitalized costs and operating costs of large research infrastructure of at least value of 20 millions, and that represents the 75% of the fixed asset of the organization. Requirements to claim LRI, of course, that this big infrastructure is used in the action, and that the methodology to define these costs are positively assessed by the European Commission. So actually you apply for this, you will be audited, and you will receive the outcome of this audit. And if positive, after this you can claim large research infrastructure costs. The last one is the internally invoiced goods and services costs. It's quite recent, this cost category. So attention, very often confused with goods and services contributed in kind against payment. It isn't the same. Contribution in kind implies that there are two legal entities, two different legal entities that may be of the same group, okay? Sisters companies, mother-daughter companies, etc. Here we are talking about only one legal entity with different departments. For example, there is the catering department that supplies food, drinks, and coffees when there are big events within other departments. So, yes, what cannot be, because I think already covered, yeah, it can be self-produced consumables, it can be hosting services as before said, and the use of specific research devices or research facilities. So one very big organization, let's say a university, there is one laboratory, and the different departments can go there and have analysis. So then this laboratory charges some costs to the other departments. How this is done? Through an internal invoice. This internal invoice takes the form of unit. It's not the actual cost. It's one methodology. They calculate the unit costs and they charge them. Let's say 1,000 euros per analysis. What not is general administrative support, accountancy, cleaning, and things like that are not considered as internal invoiced costs. Next slide. Yes. So what to take into account when I want to calculate the unit costs? First of all, I have to consider the costs, not the prices. We don't sell from one department to another. Then, this should be within our policy. So I will not create a unit cost just before to charge unit cost in Horizon 2020. If the canteen provides the drinks for free, it will be for free for Horizon 2020 project as well. The calculation must use the actual cost recorded in the accounts, as we said, excluding any ineligible costs. And here there is one asterisk, because yes, it's true that some costs are costs for you, but not for our program. This, for example, can be you take a loan to buy a big equipment, and then the bank charge you some interest on this loan. This costs, it's costs, of course, actual cost for your organization, but not cost for our project. And also, yes, and I would also like to say that in your calculation, you have to be careful so that you don't include any ineligible items. And if they are, you have to remove them. This can be, apart from the example that I brought for the interest, can be, let's say, cost of central services, HR department, accounting, etc. Shared infrastructure, central heating, cleaning services, air conditioning. And another example is that imagine that you have a staff who already claimed costs under direct personal costs. Okay? If this personnel has been taken into account in the calculation of the unit costs, it's wrong. You have to remove them. Otherwise, it's kind of double charging. And I think I'm over with this. And if questions, please. I don't know, Vasilis, if we have one question. Yes? Yes, please. Just a moment, so that our online friends.
Okay. Hello? Okay, it works. It's quite similar about one of the quizzes. It says supplies and consumables had bought and been already in stock of the beneficiary before starting the date. Are they eligible? And you say yes. It's more or less if these are bought almost at the end of the project, So they were in stock and 3-year project.
I think here the most important eligibility criterion is the sole use of these consumables. I mean, let's not stick to the date that they are bought, which are before the end of the project, and based on another eligibility criterion, it's out of the project, so it's not eligible.
Yeah.
However, what is the action task is not to buy only these consumables, but to buy and use them.
Yeah.
So if they are used in the project, of course they are eligible. Now, if you go and buy it the last day of the project, will be rejected.
Yeah, yeah. But
Because probably you haven't fulfilled some deliverables.
okay.
So here we're talking about financial assessment of your costs. Then there are some other colleagues that will assess your deliverables, and then we will check together how the deliverables are associated with the costs claimed.
Okay.
There, one of us can say that yes, they are bought within the project, they are used in the project,
Yeah.
but only for the 3 last days. When in the description of action we say, I don't know, month 8,
Yeah.
from month 8 to month 36. So this is not 3 days, it's 20 months that you didn't use it.
Okay. But I was in the case of chemicals, for
Yes.
example, these need to be used, otherwise they change.
Yes, yes.
In a chemical lab, you have them in stock, but then the project is going to the end, you need to replace what you had in stock.
This will not be eligible because you will buy them, but you will not use it for the project.
Yeah.
Ah,
Yeah. I use the ones that
Ah,
are
okay.
in the chemical lab, but then I need to.
you will charge
Yeah.
this that you used at the price that you bought them,
Yeah.
not the new price.
Okay. That's the rule. To the price where. Okay. That's clear.
Yeah. Yes? Ah, okay. Yes.
But it's now works out that it's not going to be used on the project because there's no longer any use to the project. Where does that fit in the criteria?
Okay. It's scrapped, is destroyed, is...
So it's maybe the pressure rating on it has changed. So you bought it in good faith at the front end, but when you've gone through the design side of things, it's now no longer.
So your accounting policy, I guess, will mention something about impairment. So if there will be 0 value after this test, after this set of the project, then I think the costs can be claimed. Based on your accounting policy, I don't know your accounting policy.
No, because I mean it's bought specifically for whatever the project is, but it doesn't get used in the project because it's no longer going to be able to be used in the project.
Mm-hmm.
That was more the theory. So that you've got some, in effect, some scrap equipment, but it's still good. You see what I'm saying? So it's still new. Am I going into a different zone here?
Yeah.
I would say that if there is news in the project, and then afterwards what my colleague said, and you impair it or something like that, yes, we can accept that as a cost.
Yeah.
But otherwise, it should be something like your own problem, business related. You in good faith, you buy something, yes, but then you receive something that is not good. You need to deal with the supplier, not with us.
So there is a question from an online friend. Question on equipment. is it possible to depreciate the difference between the cost of a diesel bus and an hydrogen bus at an accelerated pace compared to the normal depreciation of the diesel bus? If yes, what is needed in order to adapt our accounting practices? I think here we are referring to delta costs, the difference between an hydrogen bus and a diesel bus. A diesel bus, it's tested, it's every day on our roads, so we have an accounting policy of depreciation, let's say 5-10 years, I don't know. The hydrogen bus is something new. So you take a risk, you buy it, you don't know, okay. I think that based on some international accounting rules, you can depreciate this type of bus differently than a diesel bus. So the delta will not, the difference actually in price, buying the diesel and the hydrogen bus, will not be subject of depreciation, and just the remaining will be depreciated as a normal diesel bus. So I think that this can be acceptable if in accordance with the accounting practice, the international rules. To adapt this, I think your internal auditor should know better how to deal with this. What do you think, Elizabeth?
I think that indeed it has to be in accordance with the national accounting standards, and then ensure that the beneficiary puts in place the system to that. But so I understand that accelerated depreciation is possible if indeed you can demonstrate that the value of this bus or this additional value does not reflect the real value, that in fact if you were to sell it, you could not sell it at this increased cost. So I think it is possible, and it has indeed to be recorded in the accounts.
And I propose to the friend sending this that contact us to see if we have any case in the past that we can propose something more concrete. Yes. Yes?
I think there is some kind of a time period you are supposed to use this. It's probably hydrogen bus jive or something. So I think it's that's why he's asking these questions, is because you are supposed to use it for 3 years, I think, or amount of.
How I understand the question is that they have a policy for buses, but diesel. So that's standard, let's say 5 years depreciation period, or 10. But they feel that with the hydrogen buses, they don't know if they can go for the same depreciation period. And to limit, let's say, the risk, they want that they reduce the depreciation period for the hydrogen bus, and the delta in the price is not depreciated. This is what I understand from the previous.
No, I understand from the question that that delta will be depreciated at an accelerated.
And accelerated.
Yes, over 3 years, or yes.
National law,
yes. Yeah.
Okay. Thank you.
Thank you very much, Thanos. So now I will invite Frank Zender from KPMG.
Do you want that we take this table?
Maybe first, Frank, you will do the presentation, and just after we will change a bit.
Change a bit the setting here.
Yeah. Yes.
Okay. Do you want this maybe? Yeah?
No, I take
okay, great.
I guess it's only a short presentation, so probably it doesn't just the time to change the microphones takes longer afterwards than holding the presentation. So do we have slides probably? I'm not Ivana. Maybe I can just take the time and introduce myself a bit. My name is Frank Zender. I'm working for KPMG in Germany. I'm being a chartered accountant by German law. And KPMG is, since 2009, we are in place as a service provider for the European Commission, for the joint undertakings as well, just to perform external audits for them, so the so-called second level audits. And I'm leading the central team in Germany, which is on the one hand in charge for performing the audits in Germany, and on the other hand in charge just to coordinate, manage, and being responsible for the audit findings of the audits all across Europe, where we're using our KPMG colleagues in the different countries then. So that's why we have seen a lot of audits so far. Of course, I don't remember all the findings and all the backgrounds, but we approximately just run 1,500 audits over the last years. So there's a bigger experience on our side. And hopefully the slides are there now. No? Yes. And that's what I would do now. I just provide or just prepared a quite short presentation, only a few slides without questions, because the questions comes afterwards then. So you have probably 10-15 minutes time and you don't need to vote anything. It's just like the session is titled with how to avoid errors in H2020 financial reporting, and we will come to all the specific cases. Then afterwards, Elisabeth prepared slides with questions that drives us or brings us to specific cases, and also to maybe not easy to answer questions, but part of how to avoid errors, if we considered errors as being findings that leads to that there is a need to pay back the money. Errors also stems from things that happens during the audits, sometimes misunderstandings or other issues that comes to the findings then. And that's why I thought it would be good just an entry to that session to provide some short slides about what this audit means and what is our perspective as an auditor, because that's more or less the only perspective I have as an auditor on these audits, and what is important for us to avoid these kind of errors. So I have just 2 points on my agenda. The first thing is just quickly demonstrate what we are calling the EC audit approach, so kind of the quality or the quality framework that is installed by the European Commission. And the difference between the audits then brings me quite quickly to my second point of the agenda, what is important doing an audit that we call the second level audit. And why it is called the second level audit, you directly see it on that page. We have more or less two parts of that quality framework. The first thing is, and you probably are already well familiar with that, is the so-called first level audit. So whenever you are issuing a cost claim under certain circumstances, this has been accompanied by a so-called audit certificate that is provided by an auditor, or in certain instances by your internal auditors, for example. And the second thing is that comes afterwards, once you have claimed the cost, once you get already the payments, then there is a kind of a second level audit, so audits that are installed by the European Commission itself, just coming to your places and just see whether whatever has been claimed in the past years really fulfills the eligibility criteria. That's where we came into the game. So it's the external auditors that performing these audits for the European Commission. And there is more or less a third layer, but that is something we don't get in touch with neither we, so we sometimes as the auditors, but the beneficiaries you're on, so on your side you don't see that much, is a kind of a third layer whenever the European Court of Auditors audits again the audit system itself. So they are performing or reperforming audits that have been done by the European Commission, or they are just chasing our quality systems, for example, in terms of how we came to the findings and the audit conclusions. So that's quite, I would say, a formalistic thing, but important to know in my opinion, because quite often when we are coming to perform a second level audit and we are raising questions, an answer is, why are these questions raised? Because I'm already audited, and what is meant is the first level audit and everything was fine. And that brings us to the just to the point that we wanted to highlight the differences between the first level audit and the second level audit, and the difference stems from the professional standards we are using for these kind of audits. The first level audit, in parentheses, is from a professional point of view not an audit, but so-called agreed upon procedures. What simply means that we have a kind of a checklist. You always see that as attachment to the certificate itself, where questions are raised, and the auditors just simply go through these questions and perform procedures they are agreed upon. So just simply, without, to be honest, without using professional judgment, that would be in pure terms the meaning of agreed upon procedures, without using professional judgment, just going through these procedures and say, could I perform these procedures? Have I seen what was necessary as evidence, as documentation, or did I just face problems in simply doing that? And if I face problems, I have to report about them as part of so-called factual findings. So the first level certification never ends with a statement of the auditor saying costs are eligible or not, or part of the costs are not eligible. They are simply saying we have performed procedures, and these are the findings we had coming out of these procedures. The second level audit is totally different, because that is an audit in the terms of what we as professions mean or understand from an audit, and without going through all these details, because it sounds to be the same, but the most important difference for an auditor is that in the second level audit, the auditor has to perform procedures to the extent he feels necessary to form an audit opinion. And an audit opinion not simply means I have performed procedures, but the audit opinion means with everything that I did, I can sign that the costs are eligible. So that means all the costs that were claimed, except maybe for the findings that I had, all the costs were eligible and fulfill the eligibility criteria. And there, where these differences comes from, and that leads me then to the other part of the agenda. In the second level audit, the auditor, it's much more depending on the information he receives from your side, so from the ones who did the financial reporting, to understand all the specific, all the circumstances that were necessary to come to the conclusion that costs are eligible and treated in the right way. I think that's really, at least from my point of view, that's a quite important message I just wanted to put on the table and to bring to you, because that's really a difference between the two audits and what at the end the audit reports are saying. So what the certificate is saying and what the audit report is saying. And that just brings me directly to that slide here, because how to get the things right in terms of how to bring the auditor in the right direction and how to avoid that the auditor is maybe going in the wrong direction. And the point is really not only the overall timely delivery, but I would more say the complete delivery of information at any stage during the audit. Stages of the audit are just mentioned here on that slide. It starts, of course, with the letter of announcement you are receiving, and it ends after months, maybe, with a contradictory procedure where the beneficiaries have the right and the obligation just to put their statements to the audit findings that are on the table. And within that process, we have different stages where we as auditors trying to structure ourselves a bit and to use the time as efficient as possible, just to focus on, I would say the real important things. And this morning, I think we just have heard a lot of issues around personal costs, subcontracting, in-house consultants, all that stuff. And I think the question and answer sessions gave a good picture of how complex these cases sometimes are, and how difficult it is to find the right conclusion at the end. And I just remind I always reminding myself that it's, when it comes to an audit, it is really important to understand the full picture. And that's where you, as the ones who are responsible for the finance reporting, comes into place, because at the end, probably you have the full picture over the years when that project was running, and the auditor comes at a certain point in time, and definitely from apart from some obvious things, the auditor doesn't know everything that happens in the last 2, 3, 4 years, and the auditors doesn't know all the discussions you had with whoever. Might it be internally with the ones that are performing these projects research-wise? Might it be with project officers, whoever? That's why for us it is important that you help us in all these stages to focus on the real important things, and the real important thing for us is that one here. Because beforehand we just try to, at least that's how we are structuring the work. We are just sending emails asking for the basic documentation, just to understand how your time records look like, to understand how your time recording process works, to understand some specifica in the process, to be able to draw the samples that we are just obliged to draw, just simply due to the fact that based on the sample we have to conclude whether the whole amount of costs are really eligible or not. So we have to draw a sample, and it helps us really a lot if we already get the information beforehand, because we can use already time to draw the sample, to evaluate the documentation that we received. And then when it comes to the field work, so when we are on site, these other days then we would like to spend to discuss with you directly certain issues. So not go through all the documentation again, but of course that's also sometimes necessary, because confidential information cannot change exchange via email and all that stuff. But at the end, the field work for us, the most important thing in the field work is to understand the project, to understand what happens, and to discuss certain difficult cases with you. And that's then during the field work. For me, the most important point here are these two: being open-minded and providing documentation evidence to the extent that you feel is necessary to know for the auditor, just to draw the right conclusion. It's sometimes like, we are asking questions and we are getting answers that are quite focused on that question, literally. But to understand what really happens, to, for example, judge whether a contract is a subcontracting, another good, whether an in-house consultant should really be recognized under the personal costs are somewhere else. It is important for us to have the full picture and all the information you had on hand to come to that conclusion. And that's for us a really important thing, and that's for me the main thing to avoid these errors that are mentioned at the beginning of my presentation. If at the first instant we understand on what basis you came to the conclusion you have drawn when setting up the financial statement, that helps us a lot to find the right conclusion. And it's always a unfortunate situation, to be honest, if you ask a question, for example, how came you to the conclusion that this contract should have been recognized under the subcontracting costs, and it takes you, or at least from an auditor's perspective, it takes a month, six weeks to provide something that gives you as auditor at least not really a sign, but a certain hint that maybe these discussions and thoughts have not been made when that contract was evaluated and when it was decided how to recognize that in the financial statements. So that's just a bit like that's the message I would just bring to you, that the auditor is not the one who came to you thinking that everything is wrong, and we are not paid in terms or related on the findings we had, or just the money that we have saved for whoever, the taxpayer or whatever. We have when we are fulfilling our contract, we are responsible for what we are issuing at the end. So me personally, for example, I'm signing the audit opinions as well. And of course, I'm a bit dependent on the information that we got to draw that conclusion. And if we don't get the information that we need, at the end we don't have any chance to conclude in a way that we think is correct. And it's always better to see at the first stage the thoughts people made when setting up the financial statement. So, in my opinion, you are a quite important piece in that picture of how to avoid errors in the reporting. And that brings me to my last slide, and then we can start with our question. I know that that's a quite I would say difficult sentence to transport sometimes in your organizations. At least that's our perspective from an auditor side as well. Sometimes it's not that easy for the finance department or the ones that are in charge to setting up the financial statements to get all the information that are necessary from the research department, for example, or just to highlight a bit their understanding of why it is important to have the documentation on place, or at a certain point in time just to simply write down 3, 4, 5 sentences why I took the decision as I did. Because if you do that during the process, it's much more easier 3 years later to remind yourself again why you took the decision as you did. But still, it's a quite important sentence. Of course, the science is very important because the science is the aim of all these projects. But at the end, a reliable financial accounting and the efficient management of all the process is maybe not that important than the science, but at least it's also a quite important piece of that picture in terms of to be successful at the end. And successful at the end for the company means to get the money, to get the funding, and to hold the funding at the end, and not be in the position to have to pay back money after an audit. So that's what I wanted to present as an auditor. And usually we have slides in our presentation where we go through the common mistakes in personal cost, in subcontracting, and so on. What we decided, as this is covered by the question Elisabeth just prepared, we would shorten the presentation to that minimum, and we would go then through all the questions, and I would step in whenever I can, just be of benefit in answering certain questions then. Thanks very much for your attention. And now it comes back to the voting.
Thank you very much. I propose just to change a little the seating arrangement. So I'll invite my colleagues to sit here, and we will add 2 chairs just here for Frank and myself. So maybe we we have the screen first. Okay. Just, yeah, otherwise we cannot see the questions. So thank you very much. So just I will complement the comments from Frank on the 2 layers of control regarding audits. And afterwards, the idea is to have questions, and we ask you to vote. It's just to know whether you use one approach or another and have an idea of what's the practice among yourselves, and including the online participants. And in response to that, have an exchange with Frank, and my colleagues can also give what is their experience when doing the ex-ante controls, for example, or doing the grant preparation agreements, and have an exchange with you on those points. So on the 2 layers, as Frank mentioned, we have the certificate of financial statements, which is the first layer. The auditors are appointed by yourself. And then the second level of audits, which are the ex-post audits that are carried out by firms like KPMG. So the certificate of financial statements, so I would like to complement to explain, in fact, the timing. There is only under Horizon 2020 one CFS that is to be provided at the end of the period. So there's only at the final period a need for a certificate of financial statements, provided that the contribution that you request from the FCH, from the union, is more than 325,000 euro, and this is applied to the direct costs, so not to the indirect cost or SME owner costs. The cost of this CFS, so the price that you pay to your auditor, is an eligible cost in the category other direct cost. And okay, as being a direct cost, you also have then the 25% flat rate for indirect cost that applies to it. And what will this work be consist of? As Frank mentioned, these are agreed upon procedures. So there is a model template, there's the model of the report, but there's the model of the procedures that the auditors will perform. The difference with Horizon 2020 audits is that these can be done as soon as the first payment of your first reporting period, if you have several, it's from the first has been done. From that point on, you may have an ex-post audit, and you may have this up to 2 years after the final payment. Who performs these audits? Well, it's either the Common Audit Service from the Commission, who is in charge of these audits for Horizon 2020. As they do not have the capacity to perform all of them, they also outsource audits, and this is the case where you can have firms like KPMG that will come to perform this audit. And as Frank mentioned also, so this is a real audit, not merely agreed upon procedure. There is an indicative model audit program, but beyond that, they perform further verifications or controls depending on their judgment and the findings they have. So now we will go through the different questions that will be the subject of our exchange of views. So the first question is, do you keep timesheets with the 6 minimum requirements? So if you would like to answer just by the poll. think it's just to have an idea of what's the distribution and whether all of you do or not. So we can see that a large majority have. Everybody knows the 6 requirements. Would you like, Nora, to remind what the 6 requirements are?
So the requirements are listed on the timesheet, but they are basically name of the project, number of the project, then name of the beneficiary, then name of the person working, hours, how is it related to the action, which means work package or a short description of the task, then the 2 signatures, the person who works and the supervisor. And we said in the case of SME, of course you don't have a supervisor, so 1 less signature is acceptable.
So Frank, we see that 90% of the beneficiaries have proper timesheets meeting all the requirements. Does this correspond to your practice when you go on the field?
Maybe our sample is a bit different then whenever we are receiving the audits. No, it's, you know, at the end, it's, if we really talk about the 6 minimum requirements, I would say probably in 70, 80 cases, we really have all the 6 on it. It's just like to remind you, why do we have these 6 minimum requirements? Is at the end, for us as auditors, we need to have a time recording that is auditable and reliable. And the reason of how can you document that the audit, that the time recording is reliable is just simply, that's why we have the 6 minimum requirements. And I think it's not a secret that, of course, some of these 6 requirements are more linked to the reliability and others are not that important. Just for example, if the signature of the employee is missing, it's probably a bit more important than if only the grant name is mentioned and not the grant number. So that's just, of course, then if not the grant number is mentioned, a minimum the requirement is missing, and we would give a recommendation. But of course, it doesn't matter in terms of how the reliable is the time recording. If the signature of an employee is missing, we just have to perform alternative procedures. That's how we call it, just to dig a bit more into the details to assess whether the time recording is really reliable.
I have a question. If I'm a beneficiary and I had a system with, for example, daily timesheets, and then the system will change, we'll move to monthly timesheets, and then there's a problem with the system, the application, and I got a month lost, no timesheets because of the change of system. What happens? What would be then? Do you have this experience, or if not, what would you do as an auditor?
Not really with a month that is missing, but of course we have experiences with time recording systems in a sense of being a electronic system and not really a paper-based system anymore. And I mean, if in your case, in your example, for example, if a month is missing, we would at least expect that for that missing month, already alternative evidence is prepared in a way. Like, I mean, there is if you set up your financial statement and you are saying the employee worked whatever 1,500 hours in that year, and there is a month missing, and the question is, where does the information come from then? And so there must have been a system where you have drawn the information from instead of the pure time recording, and at least we would expect that we see that alternative evidence then to understand where these hours in that missing months comes from. So as a summary, of course, missing timesheets is always an unfortunate situation, also only for a month, but it's not, so to say, a dead end. Of course, there are always the opportunities to document the hours in a different way, but at least we would expect that there is something on the table and in place then.
Thank you. It could be also that in my company I have a SAP system with a batch system that records when I come in, when I get out, and so there's a number of hours here. But I have timesheets that I use for my reporting. Yeah. Do you check that these are consistent and?
Yeah. So that's my call to that is always the more elaborated your systems are, maybe the more, I wouldn't say problems, but the more points for the auditors just to base their audit on that you have. And of course, if you have a so-called click out system, so that was badges whenever the employees are just simply present in your offices, that is kept in a certain time recording system or in a certain system. That's of course a basis for us just to evaluate the reliability of the time recording itself, but just simply in a way that we would expect that whenever you have then paper-based time recording or allocated hours to the project subject to the audit, that these hours are not higher than the click in and click out times for that day, for example. And if so, that would at least raise questions then.
Okay, thank you. Do you have any question or any comments that you would like to add on this point? No? Then we can move to the next point. So do you use the 1720 fixed number of hours, so the standard approach for annual productive hours?
So let's
this
bet.
Is just...
let's bet, I would say 80% no.
All right, let's see then what... we invite everybody to respond so that we can see a bit what is the distribution. Okay, so it's close to what you were saying. So what is your advice on this? Is it a source of many errors, the fact that beneficiaries do not use this simplified fixed number of hours under Horizon 2020, or do you find many errors then in the calculation of productive hours?
The point for me was that the 1,720 hours was a kind of a simplification, and it totally makes sense that only beneficiaries are using that option who don't have a elaborated time recording system. So whenever you have a time recording system where you can put the hours off, probably it is more fortune for you to use one of the other options than the 1,720. Depends a bit on the country as well. So for some countries, 1,720 might be a quite high number. That's why the hourly rate would be quite low. For other countries, it might be the other way around. But our experience is that the 1,720 hours are almost not used, at least not in the audits we have seen. But that, I wouldn't say that this is just resulting in certain problems we have with the time recording system. The more problems I see, at least in the switch between FP7 and H2020, is that in H2020 you have three methods to calculate the standard the productive hours. That's quite good because you have three options. But what causes problems sometimes is that you have to definitely stick to one of these options, and sometimes, but just a result of the cost accounting systems, for example, of beneficiaries or of the time recording itself. It turned out that the calculation of productive hours is a kind of a mix between the two options. So like you are using individual hours for the employees until it comes to the illness days, and for the illness days you use an average over the company. That's at the end, it's not really wrong. The question is whether it is appropriate, and at least in the meaning of the Commission so far, it's that you have to stick to one of these options, and you cannot use a mix between both. So whenever we see these issues, we then have to think about to what direction we should go, either to really calculate the standard productive hours on a real individual basis, or to fall back to a standardized approach.
So maybe linked to what you said at the beginning, 1720 may in certain countries not be really corresponding to the norm. So I don't know if we are a university, an Italian university, and it's 1,500 or 1,600. What would you recommend? Or
it really depends. I mean, what is the main benefit of the 7020 is that it is quite easy to use, because you don't have to have any elaborated time recording system behind that. There is no question about, do you use a full-time recording or just simply for the project. It's quite easy to use, except for the prorata, because there sometimes we just see issues. What I mentioned this morning, especially in Germany, for example, one would say the usual working hours per week is 40, but you see the bigger companies where per the contract the hours are limited to 35 per week, for example. And the question is that already a pro rata, or is that still a full-time employee? And that's why I meant this morning, you don't have to compare it to your national whatever surrounding. You have to compare it to your circumstances within the company. So it is quite easy to use, but in most instances it's not for the benefit of the beneficiaries. So in my opinion, probably the standardized approach is still easier to use and to use than the individual one. You will always have, of course, different hourly rates. Standardized approach doesn't mean that you have one hourly rate for all the employees, because the only thing that is equal for all the employees is the productive hours. But of course, the salary is different for all the employees. But you only have I would say you only have one item really to calculate individually, and not two items in the calculation. And the second thing is that in the individual approach, at least that's also issues that we have seen. Beneficiary starting with what is in the time records. So, for example, of course, whenever somebody is present at the beneficiary, is working for the beneficiaries, you will see hours in it. But if that guy is ill, there is nothing in it. And then beneficiary starting with the starting point for my individual productive hours calculation is what is in the system, because that's the productive hours of that guy. But that approach doesn't follow what the commission is expecting, so that you calculate the workable hours and then deduct the other timing. So at least that raises questions, because it is not easy then to understand how these hours are calculated and how the time records work, and whether the hours that are not recorded are really absence hours or other hours that are missing. So there is just simply no starting point to do that evaluation. So that's why, in my opinion, I would say the standard approach is probably the most easiest approach to use.
Meaning, so the fixed 1720, yeah?
No,
the standard. Okay.
But from your experience, which one is most used? The method 2 or 3? The individual or the standard?
The standard. Yeah. Because it's standard productive hours is quite a good mix between being close to actual cost of that specific employee and the workload that is behind that calculation.
Thank you. Are there any questions or comments? Then we move to next point. So in case you use services of in-house consultants, do you have contracts directly with the persons or do you go through an agency? Maybe you have both, but just the question is, do you have contracts with the person? Okay. Okay, so it's about a mix, but so meaning then that it is through an interim or HR agency. So do you see a lot of this when auditing?
Yeah.
Yes.
So I mean, also there it depends a bit on the tasks that are performed by these in-house consultants. But in the most cases, even if from the beginning it looks like that is a contract with a national person directly, it turns out to be a contract with a company, and the reasons for that are sometimes the national the legislations as well, because there are in some the instances for people that are working as a freelancer over years. They almost have a one-man company installed for that they are working, and in very rare cases, people are working really working without belonging to a company that has tax reasons and all that. So that's why it is quite usual that you will have a contract with a company and not with a person directly.
Okay, so here the risk may be that if you do not know well the rules, you could account for this under personnel cost instead of other direct costs, so meaning a reclassification with no much impact on the contribution. However, a question I have is, so do these people also maintain timesheets?
Depends on the contract. I mean, there are, in my opinion, there are three options how that contract could look like. The first thing is you definitely have an hourly rate in it. So then I would expect that there must be a time recording, because you are paying that person based on the volume of hours. So I would say as a usual sound financial management, I would expect that you are paying somebody only if he provides you the documentation how much he worked then. So that's the first thing. The second thing is you only have a fee in it without saying something about, for example, a monthly fee, without saying something about the workload. Then you have to use the 70-20 hours just to calculate an hourly rate, and also then we would expect to see a time recording. And the last option is that you have in it a fee combined with hours that needs to be worked in a month, for example, so that you can calculate the hourly rate out of these two informations. And also there, we would expect to have a time record. So there is no, at least I cannot remember any case for in-house consultants where we haven't seen the time recording.
Are there any requirements on this specific topic on how you select the company? Do you have to prove best value for money when you use a HR or interim agency? Maybe.
Yes, he said yes.
Yes, best value for money is.
Okay, so this is something you would check also as an auditor when you go on the field?
Yeah, and honestly, it's quite hard to check, because usually, how should the best value for money approach look like if you are working together with the agency providing temporary employees? So it's more like at least we would expect something why you decided to use that agency and not another. And it could be that only that agency is able or is just handling certain experts, because there are there are focused and specialized of these kind of the employees, for example, or this kind of knowledge that could be an issue, or just simply that you worked with them for over 5 years and you just and the flexibility is of your benefit, for example. But at least we would expect a good argument why you chose that agency and not another, but not the kind of the 3 offers and things like that.
All right. Then in reference to the presentations of this morning, for example, and the nature of the tasks that are performed by these people, do you check that?
Yeah, because that is one of, I wouldn't say the eligibility criteria, but at least when we talk about what is the right column to put these costs in, we have to check the task that they are performing, and there's also kind of the instances I mentioned in my presentation. Of course, we are certain sometimes depending on your information to understand what kind of task it is and whether it is related to the core action task of the project or just simply an auxiliary task. Because I guess we have understood this morning that it is not easy and not always black and white in that aspect.
Yeah, and also we have this classification between demonstration, RTD. Are you able to further check that to distinguish whether or not a task or a person was working? Any other cost category? Are you able to?
I mean, at least if the time recording fulfills the 6-week requirements, you have at least a starting point to understand in what the work packages that employee worked and recorded the hours.
Okay, thank you. The next question. In case of an SME owner without a salary, does the SME owner use unit costs to calculate salary? So do you use the SME owner rates? So this is to check among the participants whether they use this system. So they would, if they are indeed, or there's maybe only one answer. There's only one answer. The question I would have, Frank, is you may have audited SMEs with only an owner without salary. Is this an area where there are mistakes, where there is misunderstanding?
Yeah, definitely. At least in some the legislations, that's one of the I would say rules that are causing the main problems and mistakes maybe. It's not like, I mean, the 100% answer is quite good, but at the end, to be honest, it's not the issue or the problem to use that unit cost, that specific rate, because whenever somebody just considered that this is an SME that falls into that case, it's not the mistake that then the beneficiaries do not use the unit cost anymore. The more problematic thing in that is to evaluate whether this is an SME owner that falls into that section. So is that somebody without a salary or not? I mean, honestly, the most answers we are receiving is, of course, the SME owner is getting money. He doesn't work for free. So we see quite often that the consideration of what does it mean an SME owner without a salary, that there the problems comes from, because it is not that easy to consider or to assess whether whatever that SME owner gets as payment, might it be as a one-time payment in a year or spread over the year in monthly payments, whether this needs to be considered as being a salary in the definition of the rules, or whether it's not a salary. And if you look into the rules in the sections where there is a discussion between the basic salary and the additional salary, there is a kind of I would say short definition of what is mean with the technical term salary, because there is said a salary is a remuneration that stems from a working contract or a contract similar to a working contract. And that's what we are using when we are going to assess that. just to understand whether the contract you see with the SME owner, whether that is comparable to a working contract or not. And at least in Germany, but in other the European countries as well, the first instance is already whether that payment the SME owner gets, whether this is subject to a social contribution or not. And if that's the case, you have an SME owner with getting a salary then.
And in that case, the eligible cost would be the salary.
Correct. Yeah.
Which may be also more interesting for the concerned person. And as you say, I think it also depends on the legislation of the countries. You have in France, for example, mandataire salarié, so who gets a salary, but you have other types of relationships which are not the same, or you may have dividends, which is not a salary and not subject to payroll tax. Next question. So do you have evidence on the selection of a supplier? So if you have bought something, do you keep evidence that provided it is above the thresholds applicable in your company or public thresholds if you're a public entity for procurement, do you keep this evidence? Oh. So what is your experience in this field? Do you usually see the evidence? Do beneficiaries, do companies keep evidence that they went through a procurement process so that they indeed chose the best value for money?
Also there,
field where you have lots of errors, lots of
at least not really lots of errors, but at least lots of questions we have to raise during the audit, because I would say that result we have here almost 50-50 mirrors a bit what happens in the field or during the project work, because I would say whenever you have services, goods, whatever, bought directly for the project, and within the project period, you will I would say always see a selection of 3 offers, or at least a documentation that underlines the selection that have been made. But the other 50% relates more or less to, I would say, specific cases in terms of the projects here, but quite usual cases in the beneficiary practices. That is like, for example, if you have a framework contract with a supplier over five years, and your employee is just simply taking goods, services, whatever, under that framework, you will of course see no specific evaluation procedure for that service or good that has been requested specifically for that project now. So, but also there, we would at least expect that whenever that supplier has been selected, might it be 3, 4, 5 years ago, that for that procedure, there is at least still documentation on hand that shows why that supplier has been selected, and that caused sometimes a bit problems, because of course I would say in the usual project documentation, it is not available anymore.
And what if there is only one supplier that can deliver the specific good or service that I need?
That's also okay, but we would then expect not only for our audit, but the best practice would of course be already when setting up the financial statement, a documentation why that some supplier was selected on a basis, as you said. So why this supplier fulfills these the specific criteria that no other can supply or provide. It depends also a bit on the business of the beneficiary. You could, for example, imagine that you have certified some suppliers that cannot be easily changed because they are fixed. And changing them would maybe have an impact on the research results and all that things. That is all that is reasonable, but it needs to be documented then.
And this raised me a question, because maybe indeed there can be, what is the weighting then when you do this selection? Maybe I can buy very cheap Chinese products. Then do I have then to buy that one? Because in
No, in terms of the best value for money, I guess we had that example this afternoon or this morning in a presentation where you have a selection procedure, and the question was whether you always have to use or to select the one who is the cheapest one. Of course, price is not the only evidence that needs to be taken into calculation. On the other hand, you can imagine as an auditor and for the documentation, if the cheapest supplier has been selected, there is no further documentation necessary, because obviously it was the cheapest one. But if you have a matrix like that, and you intentionally select somebody who is not the cheapest one, we would at least also there expect documentation saying why the one who is more expensive at the end brings the best value for money. And honestly, the auditors are not the better the researchers, or can assess all this stuff into the details. But we would at least expect a documentation that sounds reasonable.
Yeah, possibly you need to wait and document that you give a bigger weighting to the quality versus the price. This could be
and maybe just a addition, we shouldn't forget that it should follow the usual practices of the beneficiary. So of course, if somebody is saying, of course, I always ask for offers from China as well, because I have to do that, and at the end I never taken the ones that come from China. That's of course also a documentation. But if it turns out that this is only the case for a European funded project, and for all the other activities, of course, suppliers from China are selected, it's a different picture then. Huh? So it still needs to follow the practices of the beneficiary.
I want to take advantage of this question. As before said, we can receive consumables, let's say, from in-kind contributor. Okay, in this case, we don't have a selection, we have our in-kind contributor. I have seen cases where, let's say, gave 10,000 euros consumables to the beneficiary claims the 10,000 euros, and then we have an audit where the auditor disallow the 100% the 10,000 euros. The reason is that the beneficiary couldn't prove that these are the cost and not price. One question. How you assess that? Do you go to the in-kind contributor to check? A second question. We say here that we want to be actual or very, very, very close to actual. Rejecting the 100% of the costs, for me, it's not that close to, even if we include, let's say, the margin, we are closer to 100%.
Yeah. And now it comes to the fact that at the end, the auditor has draw a conclusion. So the first, to your first question is how to assess that. The first point is that we need a documentation from the beneficiary itself. So it's probably, I wouldn't say that there needs to be a proof from the beneficiary side, but at least there is an obligation for the beneficiary to document that the cost claimed fulfills the eligibility criteria, and not the other way around, that the auditor has to prove that it doesn't fulfill. So at the end, it's still the obligation of the beneficiary that in your case, for example, that the claiming is based on the cost of the affiliate, for example, and nothing else. So, of course, we cannot go through the affiliate and understand their cost accounting system, but it depends a bit on the documentation that is provided. So if you, for example, see at least documentation that looks like coming out of a cost accounting system saying, look, these were, and that's how it normally works. These are the elements of our cost accounting system, and we took them into consideration, and others not, because there are indirect costs, whatever. Then of course there is, at the end, it sounds reasonable that these are the costs incurred at the level of the affiliate entity, and that's it. The other way around is, what if that cannot be documented? It's just simply, I don't have any documentation on hand. I don't have any insights into the cost accounting system of my affiliate. They just simply said, these are our costs. So there is no basis for an auditor to start an audit upon. And then we don't have any other chance than to say, what we can state is 10,000 euros do not fulfill the eligibility criteria. On the other hand, we cannot say, but maybe the 7,000 euros would. So that's not our task, and that's why in these cases it always comes to the end that if the cost cannot be documented, we have to.
I understand. I knew your reply. However, if we put some zeros in the amounts, then this give a terrific error rate. So in this case, what do we do? Can we treat the 7,000 euros the same attitude as if were 700,000 euros? What will happen if the amounts are big? In my opinion, we have to do something. We cannot say you don't fulfill the eligibility criteria and to reject the 100% of costs.
At the end, it's also there probably a, I would say you still have two layers. So first of all, this is a financial audit, and we all know that there are also technical audits and things like that. But a financial audit is first of all is focused on the eligibility criteria, and if they are not fulfilled, then we as an auditor performing financial audits and giving an opinion, and if you read the opinion as a result of our audit, it is saying that from the cost claimed, except for a certain amount where we have findings, the rest fulfill the eligibility criteria. And then full stop, and it's not like they don't fulfill it, but it is reasonable that they have been claimed. First of all, they don't fulfill the eligibility criteria. And then how this audit report is used in terms of asking the money back or things like that is maybe a different question. But the end of, and it seems to be a bit harsh maybe, but on the other hand, it is still an obligation to document that the criteria are fulfilled.
Thank you. Are there any questions from the audience? Yeah.
Yeah. Many questions.
I was just wondering, because we have a common public procurement agency which keeps all the documents and all the criteria for selections. So it's not in the company who is getting the grant.
Yeah, but at least if it comes to the question how these suppliers have been selected, you would have the possibility to get that documentation, or.
Yeah, I mean, it's the framework work that we use them for framework, but for tender procedures, for example, buying of buses as we do, it's inside our company, and that's another question, because there is a committee of public procurement who is, at least in my country, always giving some issues or I think it's issues that the tender procedures was not right.
Mm-hmm.
Will that affect the grant or from EU? Do you know that? So if we tender out, for example, I'm in the Jive 2 and get 5 buses, then we get some complaints, and the committee of procurement says that it was not done the right way. But anyhow, we still proceed with the buying. But maybe after 5 years, we were filed and said that you made the wrong decision and you have to pay some fees to the other bidders. Is that something that I have to keep in mind? But it's 5 years maybe after the period of the project.
Oh, no, 5 years after, if we
The final
it's 2 years
decision.
after final payments, then no. Then I don't know if they found that there was something wrong in the procedure. It depends what it was. I think maybe it doesn't jeopardize the fact that you went through a procurement procedure. Maybe you did not respect some of the rules, and this entity that is in charge of the public procurement got the complaint and found that something went wrong. I don't think necessarily that it would put into question the eligibility of the cost that you have declared to us. I think it would depend on what it is exactly, but if it's merely a procedural factor, I don't think it would be a reason for rejection of the costs. Any other question? Yes. There's another.
Similar sort of point here. The evidence, obviously, you're just wanting the due diligence that you've gone out to the supply chain and you've got the best value or whatever it is, lead time. Initially, what evidence are you looking for? Have we had a matrix saying, you know, this is because the bill of materials in my case is fairly significant on the parts. We've got matrix saying, you know, these are the suppliers that went into, and then the reason behind it. Is that initially sufficient? And then obviously picking up the point, you can always dig further down if there's a specific one that you wanted to go through. Is that?
So actually, like you said, I mean, of course, it's a bit. First of all, we are trying to understand the procurement procedures that are in place, and to understand what kind of document should be the result out of that procedure. And quite often is a kind like a matrix. These were the 5 biddings, and these were the evaluation criteria, the prices, and at the end, this was the ranking. And at the first instance, that's completely enough. But as I said, if it comes to that, for example, a evaluation committee that was in place ranked from 1 to 5, and at the end you selected the number 3, we would of course expect a bit more documentation why the criteria has not been followed directly. Yeah.
Thank you. I will move then to the next point. Were all affiliated entities working in the project identified in the annexes to the grant agreement? So I invite you to respond to the question based on your practice. So if I trust the answers, it's 50-50.
Yeah. And it's again 50-50, and I wouldn't say that, at least not in the audits, we had that the issue with the affiliated entities was a big one, but also there, depending on the circumstances. I would say the first 50% yes. It's like when the project setup is totally clear, and it is clear from the very beginning who is doing what. There is, at least I have seen no cases where in these circumstances somebody forgot to mention a affiliated the entity. But the other 50% is what is if the project is just living, developing, and after a certain point, a certain period of time, it turns out that it would be better, more efficient, whatever, or in terms of capacities, that you switch a certain part of your task to a affiliated entity. And then I would say that there the other 50% comes into place, because in these the circumstances, in the most cases, that new affiliated entity is not mentioned at all, and it is just detected during an audit then, that there's something happened below the cover, so to say.
Maybe our colleagues during the, if you look at grant preparations or signed grant agreements and then amendments, do you see a lot of changes that are to then amend in order to introduce affiliated entities that were not initially in the annexes to the grant agreement?
Personally speaking, yes, of course. A project is a live document. It's a grant agreement. Things change. So I have seen introduction of third parties not because they have forgotten, let's say, but because the planning is changing, and there is a good follow-up, and they know the importance to have, and we also underline this importance, that everything from the start should be tidied. So apart from cases that are necessary because the planning is changing, the strategy is changing, I don't know, the action may go for a plan B, I don't know, or termination of a partner, entering with some third parties, etc. Then no, I don't see cases where they have been forgotten third parties.
So it's not a major source of findings then ineligible because no. Okay.
No. So
Okay.
at least not in our audit so far.
The next question. So in case you have subcontracting, was it foreseen in the annexes to the grant agreement? So I invite you also to answer. So I don't know if you wish to comment on this.
I think also there's a bit similar to the affiliated entities. So whenever it is clear from the very first beginning that there will be a subcontracting, nobody forget that to put it in the grant agreement. But what is more an issue is whether from the very first beginning the contract that I have signed or maybe will sign during the project is considered correctly as being not a subcontracting, so that way around. That's the more issue in my opinion, and sometimes, but that's not a usual case. When grant agreements are set it up, participants and coordinators are not always aware that the subcontracting is a very important issue. They are just simply saying whoever performs, whether I'm performing a work stop or somebody else, that shouldn't matter at the end. But these are, I wouldn't say the rare cases. What happens more is if it comes to an issue is that a contract has been considered as being to be recognized under other goods and services and not as a subcontracting.
Yes, something is not very clear for me. Do we need to put the name of the subcontractor in the grant agreement? Because in this case, if you expect to do the tender during the project, you cannot do the best value for money.
No, you do not need to put the name. You need to put that you're going to subcontract, but not to put the name.
Okay, thank you.
I'm tempted to add that we have this statement, even naming your subcontractor in the grant preparation process doesn't mean you've done everything. It's not sufficient because you still have to do best value for money. So,
thank you. The next question, do you have evidence that purchases from affiliates were made following the principle of best value for money? I think maybe we covered already the point, maybe can we purchase from affiliates and how recommendable this is, but I think we've mainly covered it. Huh? Anyone willing to ask or add something on this point? No. So I think this is the last question that we have for the session. So in case you already had an audit, maybe under FP7, if you were in projects FP7 program, do you implement all the recommendations that are still relevant for Horizon 2020? So I invite you to respond. Maybe some of you were already audited. So, and this is linked maybe to one of the tasks that you, or one of the controls that you perform when you go on the spot. You check previous audit reports and you check whether indeed recommendations were implemented. The ex-ante controls, okay, under Horizon 2020, we go less in depth in the questions that we ask, but we did it always under FP7. What is your experience with this, Frank?
Yeah, that also mirrors quite good as a practice, in my opinion, because the 25 to 27%, in my opinion, also stems from the nature of the recommendations that are given. If you look into the reports that are the result of the second level audit, you will find a lot of recommendations sometimes. And whenever we have a finding, for example, that leads to a financial impact and a rejection of costs, we will give a recommendation, and I would expect that recommendation, of course, is implemented then in the future periods, because you would like to avoid the finding. But there are also other recommendations, like, for example, what we had a few minutes ago with time recording, and that the grant number is missing. Of course, when we are detecting that, we are providing a recommendation as well. But at the end, it's up to the beneficiary whether to implement that or not, because he knows that probably the financial impact is not that important. And that mirrors a bit the 25%, I would say, of the recommendations that weren't implemented, because some of them are maybe not practical and others don't have a financial impact.
Just to complete something here. In case of a consequent audit, if the recommendations of the previous audit are not taken on board, then we are entitled to apply financial penalties, just to know those that they are not willing to implement the audit recommendations.
Okay, well, thank you very much. I think we have been through all the questions, and we come to the end of this session, workshop. Yes. All right.
Also, an additional question to Frank, not to Frank as the auditor of European grants, but related to the question we received before on equipment. Because the question, there were two parts. One, whether it was possible to depreciate, accelerate. Another, it was something like how can they change their accounting practices? And this is the question to you as an auditor, as your background as an accountant. How these accounting policies can be changed in a company? What is the procedure that they need to follow? I guess that it needs to be in agreement with their national legislation, but how for them to change these practices?
Yeah, I mean, it's. I understand that was that example with a diesel bus and the hydrogen bus. And my understanding of that example was that the beneficiary purchased the hydrogen bus for the first time, and the question was how to depreciate it over what period in time, and how to handle that in the future. And that's a quite important point. The first of all is how to handle that in the future, whatever the decision might be. I would expect that it is then followed in the future consequently in all these cases. And secondly, at least that's my experience, the depreciation policies are quite often driven by tax policies in the legislation. So whenever somebody decides how to depreciate, in that case, a new equipment that does not fit into the, I would say, the usual tables they are using, they need to ensure that this is in line with their tax the legislation, for example, as well. And if all that is done, I would say just change your depreciation policy that you have in writing. Just add that specific thing, and it's from that point in time onwards, you are just simply treating that equipment as you considered and decided at that point in time. And as an auditor, if it comes then to a project audit, for example, I mean, the only basis that we have is to understand that this decision may be to judge whether it is in line with tax the regulation and things like that. But the main point is to assess whether it has been really treated like that in the future then, and consequently.
Thank you. So we have 2 questions from the audience online. At the preparation phase of a project, we evaluate the personnel cost, but as we are not sure who will work on the project, we tend to use an average of hourly rate. But during the project period, the workforce used may not correspond to what we submitted. Is there a way to avoid this and its consequences, paying back?
Well, I would say that this is business as usual, and there is no, maybe there is no paying back, in the sense that what you foresee in the budget, afterwards it can change. But as long as what we are going to pay attention is that there is no too much of a deviation. But if you are in line with what we consider is normal, we are not going even to ask you for details. You can be, you can incur in more costs, on year less, or in less, or the average monthly rate can be different. This is not a problem for us.
If there is a deviation, I mean, you may provide justification for that deviation, and then...
depending on the deviation, we sometimes ask or not, but as long as you provide us with a good explanation, we are going to accept it.
Next question, if equipment is bought for the project and the estimated time of life is longer than the project, do we need to claim only for the years of the use of the total cost? Thanos, would you like to answer?
Okay. Here, I am afraid we would have rejection of costs, because if you are about to claim the total costs of the exceeding the end of the project period, then these are not eligible. So your depreciation should be calculated based on the period in which is used this equipment in the project only.
So the answer is indeed you need to claim only for the years, or
only for the period used in the project.
Would you like to add something?
Yeah, maybe I would like to add something, because that is also a example for, I would say, twofold of a pro rata calculation. The first thing is if you depreciate that equipment over the lifetime, as per definition, incurred costs in a certain period of time is simply the depreciation. So in your question, yes, you can only claim the depreciation, let's say, over the three years of your project, and the remaining 2 years of the estimated lifetime of the equipment is gone then. But the second point is the answer is yes, but provided that you are using the equipment 100% in your project, because the depreciation itself is only the incurred cost for, let's say, a year. And if you use that equipment only 50%, you can of course only claim 50% of that cost, because the depreciation is only the basis to calculate the cost to be allocated.
I think also that if it is your asset, and indeed you depreciate, you have a yearly assessment of the value of your asset, where you can, if you realize that the booking value does not correspond to the real value, you may have impairment, accelerated depreciation. So that also should be taken into account. But of course, it does not change that if indeed the useful life is, I don't know, 10 years or 8 years, and you will use 5 years and it will be continue to use it, and it still has an economic value, then you should only charge the costs during the project period. So if there are no other questions, I would first of all like to thank you all, so all present here who followed this workshop, as well as the persons online. And also a big thank you to Frank for joining us and interacting with us and doing the presentation, and of course to my team and colleagues for all the work behind this, as well as for the audio team behind the curtain over there. So thank you very much. As commented this morning, the presentations will be available on our website. And we would also appreciate very much if you could respond to the evaluation grid that we will send tonight or tomorrow morning. I think this is always very useful for us. I hope you enjoyed the day and you took something out of it, that it was instructive and that you were not bored by all the questions that you had to answer. But we would appreciate your feedback in order to always improve the way we proceed with this, and maybe complete with things that we may not have covered or not properly answered compared to your expectations. So thank you very much to all again. And we are always, all of us, at your disposal if there are more specific things that you would like to ask or you have concerns. The financial officers, our legal officers, and myself are available. And also wishing that you will not see our partner in your premises, but maybe better him than our CAS friends, its Commission Audit Service friends. So thank you very much to all of you. Thank you.
I have an answer to the Norwegian case. Yeah.